Hello, everyone. My name is Brittany Button, and I'm a long-term care insurance specialist at Art Jetter and Company. Thank you for joining us on this highly anticipated presentation from Securian Financial. We are joined by Tim Go, Regional Vice President for Securian Financial. Today, we want to help you have more productive long-term care planning conversations, not only during Long-Term Care Awareness Month coming up in November, but year-round. We truly hope this helps you uncover more clients in your own book of business for you to speak with. But before I turn it over to Tim, I just want to mention that if you have any questions throughout the presentation, go ahead, type those into the chat box or question box. Either one will work. We will be addressing those at the end of the presentation. So without further delay, Tim, let's get started.
Awesome. Thank you so much, Brittany and Art Jetter. And for all of you on the call this afternoon, again, my name's Tim Go. I am the Secure Care RVP at Securian, which is our long-term care product. And today we're going to talk about how to present a long-term care solution to a client. Every single day for the last, I'd say, 6 months, I've been getting from every type of agent and advisor the question of how do I talk about long-term care? It's becoming more and more relevant, and more people are interested, and it's on the front of their mind. So we're going to really take a step aside from a product guide or an illustration, and really dive into the process of how you may want to present a long-term care solution. And if you're new to that conversation, I know it can be a little intimidation on how do you start, where to begin. So this presentation, again, it's meant to give you a rough blueprint. So presenting a long-term care solution, it can be a challenging proposition, right? The reality of aging, especially the need for care as we age, it's tough for most of us to think about. So a successful long-term care planning conversation acknowledges the risk of not preparing well for a possible elder care event and focuses on the possibility of designing the best or ideal outcome for our clients, should they experience an elder care need. We've boiled this down to a 4-step process. Help your clients understand the basics about why long-term care planning matters. Fact find to understand their needs. Address client concerns. And present a solution custom fit to address their situation. Now, helping clients understand why long-term care planning matters, it's a broad topic that can cover a lot of ground. But you'll likely want to steer the conversation to 2 main points. 1, the risk of needing care, and 2, the impact long-term care expenses can have on income. Now, how you approach these 2 points often depends on your position. If you're introducing the topic of long-term care planning as an insurance agent, you might focus the conversation on the risk of needing care and how you can help protect a client from the impact of that risk. If you're a financial advisor, you might explain that your role is to help ensure the client has the best possible income or investment outcome. And long-term care protection can help put the client's portfolio in a more favorable position. Regardless of your role, every plan starts with a vision for the future. For most clients, one of their main financial goals is to plan for retirement that allows them to live their lives to the fullest, right? 401ks, IRAs. This can involve setting financial goals to make sure that they're able to live the life that they desire. So the fun part of retirement planning. They may have personal goals, such as traveling or spending more time with loved ones. And they may recognize their retirement income and savings needs may need to last 20 years or longer. So most clients plan for phase 1 of retirement. Most of your clients are doing this. Right? Again, creating a lifestyle for their time, traveling, golfing, shopping, joining clubs. Many of us anticipate and plan for the income needed in this phase of life. Our clients frequently don't plan for phase 2 of retirement, the phase that is often called aging in place. This is when clients start to slow down and they may need assistance and help with tasks around the house. They may even end up needing help with everyday activities of living. This phase of retirement may require additional income to support these added care costs and medical costs on top of the lifestyle income clients have planned for and still need. Now, there are a lot of different ways to articulate the risk of needing care. Some folks use statistics and studies like the average lifetime cost of care, and how many adults will likely need care as they age. Now, for proponents of this angle, we have a piece called What's Your Care Plan infographic, and we'll follow up with a number of pieces that I'm highlighting here. But this infographic can be a great tool to highlight key statistics that you can use to help steer clients toward understanding why long-term care planning matters. Now, for other folks, the best way to talk about the risk of needing care is by telling a personal story about a loved one's experience with aging. Now, I'm sure many of you know somebody that has gone through a long-term care plan. And if you don't, you probably have a friend that does. More and more people I talk to, even in my personal life, will know somebody that has gone through this, right? We're living now within the silver tsunami. It wasn't coined by me, but it's my favorite term that I've heard used. The baby boomers are turning 77. And it's not too late, but it's getting there for a lot of them to get long-term care solutions in place. But what you'll find is that with the silver tsunami, a lot of people aren't prepared for what's coming, and their children and their grandchildren and their friends and their family are the ones that are going to be along with them during that painful experience, right? So recognizing the storytelling, recognizing the personal connection that a lot of people will have with an extended care event, really important to highlight. Now, of course, our most successful producers use a combination of both approaches, using statistics and using a personal story. And when you can contextualize facts with the personal story, you can help clients begin to make the connection from, well, that's just something that happened to someone else, to, well, that's something that can happen to me. However you choose to focus the conversation, there are a few key notes you're going to want to hit. One, making a plan isn't just about planning for if the client gets sick, it's also about planning for longevity. The longer we live, the greater the likelihood we're going to need help as we age. Two, Medicare doesn't pay for most long-term care expenses. In fact, it doesn't pay for any long-term care expenses after 100 days. And even within the 100 days, the type of care that will be covered is typically limited. They may need to be in a nursing home. They need to submit receipts, right? For the first 100 days of somebody's claim, a lot of times they can start at home, right? So Medicare doesn't address a real-life scenario for an extended care event. Medicaid only kicks in when your assets are depleted, and it typically only covers, again, facility care like Medicare. The cost of care is rising, and you can localize this to the client by pulling the average cost of care to their state and comparing it to the future. A tool that I like to use is the Genworth Cost of Care Calculator. There's no login. You can just look this up on your own. You can pull up a zip code. You can localize it. You can look at the projected cost of care across a timetable of years, across different types of care. Really kind of illustrate and show you and the client what the cost may be. And, you know, for me, it's pretty conservative. They assume a 3% increase in cost year after year. If you tracked or look at the historical increases in cost of care, it's gone up far greater than 3%, but it's a really good leveling tool to look at, hey, what could cost care in the future? Or what could care cost in the future? And to top it all off, there's a current and projected future labor shortage in many care sectors, and that contributes, of course, to the increase of cost of care. Now, once you've established the risk of needing care, the next step is to connect that risk with the client's own retirement income. Envision one of your clients with a typical retirement portfolio. Maybe they have a small pension, some cash or investments set aside, and a majority of the retirement savings are in a 401k and IRA. This client's 401k and IRA forms a bucket of money saved for retirement. And the retirement income is a planned stream that they're relying on to pay for their living expenses. Now imagine they live into their 80s and they need long-term care. They're now solely dependent on the same bucket to continue providing needed income, plus additional income for assistance or care. Now, this double-tapped bucket is now pouring out two streams of income, and they may run out of money faster than anticipated. In addition, they'll be paying for care with taxable income. Their opportunity to have the type of care they want may be limited, and any legacy they intend to leave may be in jeopardy. So we get to the fact-finding stage, understanding client needs. So according to the 2022 Insurance Barometer Series, the reported rate of long-term care ownership rose from 15% to 18% in 2020, representing a 20% increase in 1 year, also showing how few Americans have long-term care insurance. And in a 2022 survey, 60% of respondents say they need long-term care insurance. So that suggests that COVID raised the perceived need for long-term care coverage. What does this tell us? Consumer interest in long-term care planning has increased dramatically in recent years. With the impact of COVID, shortage of caregivers, state, federal legislative discussions around consumer unpreparedness, your client may have some interest, but they may not have had an opportunity to talk to anybody about it. So effective fact-finding for long-term care planning, it'll be centered around four main questions. Where do clients want to live and receive care? Who do they want to provide care? What are their wishes for the care they receive? And how do they plan on paying for care? At Securian, we have two really good pieces to help with fact-finding. The first is our long-term care and chronic illness quick questionnaire. It's a quick, easy way to open the conversation, help clients begin to articulate their long-term care plans. Our second piece, which is our most popular piece amongst agents, advisors, and marketers, is a worksheet that guides clients through the process of how to create a long-term care plan. The worksheet is designed to help your client take a closer look at each of these four key questions. The goal of this planning piece is to get your client to think at a deeper level about what they really want out of this stage of their life. So I see agents and advisors use this piece, the planning worksheet. They can use it during a meeting as a focal point of the meeting, or they use it as a leave behind. So you may have an annual review with your client. You may have a lukewarm or cold feeling on whether or not they want to engage in this conversation at that time. So you give them this piece, tell them to look it over, go over it with their friends and family, and then you can follow up with them afterwards. It's a really effective way to get the conversation started. So let's take a closer look at that worksheet. There's several factors to consider when answering questions like, where do you want to live? This part of the planning process, it's important for families to think through and evaluate what their desires and needs may be. How can we design a plan for spouses to stay together or family to remain close? What living arrangements or amenities are crucial for their lifestyle? Do they want to prioritize staying in their house? What would downsizing look like? Additionally, the worksheet helps clients begin to think through who is going to be involved in their care. And as we age, of course, our mental faculties, they begin to deteriorate a bit. It's natural. So thinking through things ahead of time, like who are the key parties clients want to identify for managing care, mediating family and loved ones' concerns, helping with medical situations, caring for home, managing finances. Or should the client engage a power of attorney, identify a qualified geriatric care manager, or identify a trusted financial professional to help manage their affairs? So what does a dream plan look like, right? You as their agent or their advisor or planner, you want to help the client paint a clear vision of their desire and goals. Is this plan written for loved ones to have? You want to encourage them to engage their spouse and kids or any other interested parties in this vision. Let them voice their concerns or be a part of the process and get them on board to help make this dream a reality. On a personal note, one of my good friends, and now I think one of the most respected long-term care advocates in the industry, he entered the industry because both his parents were diagnosed with severe dementia at the same time. And they didn't have long-term care planning in place. They had a financial advisor. The question was never brought up. And my friend Shane, he was kind of thrust into this situation where he had to try to figure everything out with two parents that had dementia. And it was a really, really hard situation for him, right? He didn't know where to go for resources. He didn't know how to coordinate care. He didn't know what resources they had available to them. And it was a really hard experience. So when you're having these conversations with your clients, you want to engage with their family members where appropriate, of course, because ultimately they're going to be the ones involved during a long-term care event. Now, after you've got a handle on your client's needs, the next step is helping them look at their retirement assets to decide what assets they're going to use to make their plan possible. After evaluating the assets and income that a client may have available to them, currently or in retirement, you want to calculate the risk of not preparing for care costs. Will their projected retirement income support their lifestyle, plus an additional $5,000, $10,000, $15,000 a month in additional care costs? What would that do to their retirement assets? What would that do to their legacy and what they intend to leave behind for their kids or grandkids or charities? Even for folks with significant wealth, who oftentimes are the ones at most risk at a long-term care event, it's important for them to be conscious of where their assets are held. Would they have to liquidate investments and holdings? Would they be drawing from taxable sources? More than likely, there's a planning vehicle that would be a smart investment for them and potentially put them in a more tax-advantaged position for funding care costs. Now, going through the fact finder with the client, that'll help you develop a clearer picture of their financial goals and concerns. But understanding their goals will help you make a recommendation, but understanding their concerns and making sure you address objections is critical to making the right recommendation. So, of course, before you put an illustration in front of somebody or you go through a product guide with a client, you want to check in with them and make sure that you're meeting any objections. And one of the most important parts of this entire process is to cement in the client's mind that this is a plan, not just something you're selling. And addressing any objections is how you can best accomplish that. We have a piece that goes through just about any kind of objection that might come up that we'll share with you. I'll just kind of highlight a couple that I see come up quite a bit. One of them is a client may say, hey, I don't think I'll need care. My mom, my dad died at age 65. I'm going to croak before I ever need long-term care. You may say, hey, you're right. You may not live a long life or need care, but what happens if you do? You should consider the consequences to your family. Additionally, especially if they have retirement planning and saving, you can ask a client, which you'll already know, how long they expect their retirements to last. Many people plan their retirement portfolio to pay out until at least 90. So if they're gonna die at age 65, why are they saving for retirement, right? So if they're planning retirement income well into their 90s, it's important to protect that retirement income and protect their legacy as well. Another objection that I hear is, I don't want to involve my children. I'll just take care of it myself. And of course, their children are going to love them, and of course, they're going to make sure that they're well taken care of. So you as the agent and the advisor, you've probably already seen this if you do this type of planning, but you can tell them that you've seen how beneficial it is to have their children involved from the beginning and in the process, but they're involved in all of the decisions and desires. And the last objection I'll go over before moving on is the classic, well, I have enough money to pay for care. I have enough savings, I'm self-insured. You may say, well, hey, that's great. That may be the case, but let's consider what your money's been set aside to do. What do you plan to do when you retire? What do you want to do during your retirement? Are you financially supporting any children or grandchildren? Are there any charities you're contributing to? If you were forced to use your money to help pay for care, would you still be able to do all the things you want to do? Again, affluent clients are the ones that are most often the most at risk for a long-term care event. So we've identified the need, we've gathered some facts, we've overcome some objections. Now let's create a plan. Let's solidify their plan and go through how to make it a possibility. In discussing and recording their long-term care plan, and it's important to record their long-term care plan, even if they decide not to move forward, have them sign off and have them be the ones to decline long-term care coverage. That will protect you and will also solidify the plan and can allow you to move forward. But make sure that you're recording and discussing the long-term care plan. It may be prudent for them to think through several what-ifs and have planned accordingly. Right? Help your client develop a good, better, and best plan depending on what happens next. Right? Ask what if they are just diagnosed with Alzheimer's? What if they have a debilitating stroke? What if they live a wonderful full life and just need help with their activities of living? You want to discuss the intentions and the plan with family members going through these different scenarios and documenting them. You want to review wills, trusts, power of attorneys, identify key parties, who's in charge, managing care. Do they have a geriatric care manager? Do they want one? Mediating family and loved ones' concerns, spouse or child, identify who's going to take the lead to mediate concerns and to ask questions. Is it going to be the spouse? Is it going to be the child? And who's going to help manage finances? Is it going to be an attorney, or is it going to be you as a financial professional, or maybe one of their other financial professionals? Then you want to review solutions to make care planning possible. What are the solutions designed to help? Can we create additional income to make our best plan possible? Can insurance protect us enough to ensure we can implement at least our good or better plan? And are there safety nets to make sure we don't run out of money? Now I'm going to go through a number of these solutions and where they fit. Right? I'm a firm believer, even though I have a carrier hat on and I'm biased towards linked benefit products, which I'll get to, but I'm a firm believer in long-term care planning is effective, and having at least some type of solution in place is better than nothing. And every type of solution will have a time and a place depending on the situation. There's no one solution fits all. There's a time and a place for everything. So a traditional long-term care insurance has taken a little bit of a back seat in today's marketplace. There was a big boom, right, in the past. Carriers misanticipated the cost of care and what it was going to be. So there are more limited options for traditional long-term care insurance, but there's still a number of options out there. They tend to be more budget-friendly. Underwriting can be a little conservative, and the features seem to be limited, but they do address the long-term care need by providing a long-term care benefit at a lower cost. Now, premiums typically are not going to be guaranteed. Typically going to be a use it or lose it type of situation, right? They may not be a robust death benefit tied to it. Again, few guarantees. So low cost, you're not going to get as robust of benefits. Short-term care don't really come across this too often because they're not really available in all states, but they, again, have a time and a place. The products are available for older ages. So when you have the more advanced end of the baby boomers, this could be an option. Typically will cover 1 to 2 years of long-term care coverage, oftentimes limited to facility and may have some cash benefits for home care, but it can pay in addition to Medicare benefit. And that makes sense, right? Because Medicare is limited to 100 days. This is a short-term care option. Life insurance with accelerated benefits, many of you have probably heard of, many maybe have even written, right? It's a great solution. This will be like a whole life guaranteed IUL, guaranteed CUL, guaranteed UL that focuses on locking in a death benefit, and then we'll attach a long-term care or chronic illness acceleration rider to that. So it's a really good solution because you retain liquidity and flexibility, your premiums are locked in, but you're buying predominantly life insurance. The long-term care benefit is going to be tied to that death benefit. And death benefit or mortality costs are typically, from a dollar-for-dollar standpoint, going to be more expensive than a qualified long-term care benefit. So if I go back to the traditional long-term care insurance, it's budget-friendly because, well, not everyone is guaranteed to die, right? So it's cheaper to insure morbidity than it is mortality. So life insurance with accelerated benefits is a great solution if somebody's looking for that high death benefit and is looking for a long-term caretaker to kick in in the event of a long-term care event. Annuities with long-term care riders, and on my next slide will be index annuities, are generally going to be the same. They're easier to qualify for based on health, height, or weight. You can accept qualified monies, right? You can have a 1035 in from an annuity or a life insurance product. But most of those benefits are going to be on a reimbursement basis. They're not going to provide as robust as a life insurance or long-term care or a linked benefit product because you're not going through underwriting. So we oftentimes see annuities with long-term care riders used in the event that somebody wants to use qualified monies to pay for care, or they are not eligible for other types of coverage. In life insurance, long-term care hybrid products, we call these linked benefit products. They'll be like your secure care, right? So of course I'm going to be biased, and I hope that you can allow me to set that aside. But what linked benefit products and LTC hybrid products do is that they combine the life insurance with accelerated benefits with a standalone long-term care policy, and they combine it into one vehicle. You have a guaranteed death benefit associated with it. Typically, the guaranteed death benefit will be around cost basis. Might be a little bit below, might be a little bit above. You'll have a guaranteed return of premium, which will be the surrender value. With our product, you have a guaranteed lapse protection rider. And then you have the long-term care benefit, the extension and inflation. So the majority of the benefit that you get, the majority of the leverage that you get with a linked benefit product will be in a long-term care dollar standpoint. But you have the death benefit and you have the return premium, right? So it's extremely attractive when we've seen the marketplace shift towards the linked benefit products, mostly for mid to high wealth clients, because they can more so reallocate a product rather than just buy a pure insurance product. That's a use it or lose it. Now, I know on the screen here it says under a con, not the same tax advantages for business owners on the life insurance portion. What we do, and I'll flip this, is that for secure care, we split out the long-term care portion to the premium, which will account for about half of the premium, and you can apply that portion as qualified long-term care premiums to the tax code, which will provide tax advantages for business owners as well. And an opportunity cost of funding with assets, right? You're basically taking liquid funds, putting into insurance products. That cash value and the surrender value is not going to grow as fast or as robust as, say, an investment or an accumulation like this vehicle, but it's a really good feature of the policy to be able to fall back on if they want to. And self-funding. You all probably hear this a lot. I have all this wealth. I'm going to use this in the event of a long-term care event. Pros of this is that it retains liquidity and flexibility. It's not a use it or lose it. There's no underwriting or claims process. But then again, you're dealing with the tax timing, right? And the consequences associated with that can be enormously expensive. And they're not leveraging insurance. Most wealthy people have used some sort of leverage to get where they are today, right? So it only makes sense to at least take a look at an insurance vehicle to help offset the risk of a long-term care event. So why consider insurance over self-funding? When you're looking for an option that really helps protect the client's vision for the future, again, I'm biased, but I really firmly believe, based off of evaluating the marketplace, that hybrid solutions, linked benefit solutions, provides the best fit plan. And it's not for everybody, but it does provide a very good fit plan for middle to high income clients who are healthy and already have retirement savings and some money set aside for future care. And one of the reasons for that is that these solutions really protect the portfolio by leveraging liquid dollars. So this is how it can work. Here we have a sample portfolio. Let's call this individual Dana, right? Dana's worked and saved over the years, and now she has a retirement portfolio that can generate enough income to cover her living expenses so she can enjoy the next stage of life. Phase one of the retirement planning, right? What happens if Dana's health declines? Her income will need to cover her living expenses and her care expenses, and if it can't, She's going to have to take out more money than her portfolio can replenish, or she's going to have to make some tough decisions about the kind of care she wants to receive or the type of lifestyle she wants to live. So by reallocating a portion of her portfolio into a vehicle like Secure Care, it can protect her savings and retirement income in the event of a long-term care event by essentially creating another source of income she can draw from if she becomes chronically ill. In addition, a qualified long-term care insurance solution would create a tax-free benefit or income stream to use for long-term care, helping to create a potentially stronger tax-advantaged position to her portfolio. In addition to that, right, you have the guaranteed death benefit, guaranteed return of premium, which is why this wedge is you're just creating another section within her portfolio. It's not going to be a use it or lose it type of scenario. With that, I want to open up to some questions. Brittany, I only took up 30 minutes, but figured I'd go efficient here.
Well, much appreciated. We know how attention spans are these days. And Tim, wonderful job. I mean, so much either we've overwhelmed everybody or it was clear as day because we actually didn't have any questions come in this time around. But on that note, if you get off this call, you really get to thinking about your, block of business or your clients in your book, and you have some additional questions, please feel free to reach out to the team. This is what we do day in and day out. And so we can definitely go back, talk about objections and questions you need to be asking. For those of you on the call, you will be receiving a replay of the webinar here, probably within the hour. I'll reach out and we'll discuss those handouts that Tim has mentioned as well, getting you the tools necessary to prepare for these conversations. So really, I mean, overall, I like to think of it, when you're talking to a client, what are the consequences if you need care? And not necessarily consequences to that individual, but consequences to their spouse, their family, their friends, their neighbors. If you need care, what is the consequences? How does it impact those around you and those you love? And truly, that right there is going to help get this conversation going with the folks you're working with. So with that, first, thank you, Tim, for co-piloting with me today. Great presentation. And of course, thank you to everyone taking time out of your day to join us for this. Of course, we encourage all of you to start thinking about those you need to start talking to regarding their long-term care plan. So our team is standing by if there are any further questions or you'd like additional materials. Of course, to get appointed with Securian Financial, which, by the way, they are one of our most competitive hybrid carriers out there at this time, definitely worth taking a look at. But of course, you can go out to our website, jetter.com, and click on Get Appointed to get that contracting started. If you'd like illustrations or marketing materials and additional training, though, give us a call. We can be reached at 800-228-0008. So again, thank you, everyone, and enjoy the rest of your day.